I'm joined by 4 esteemed speakers at the moment. Maybe you guys can introduce yourself and maybe highlight a little bit about your most exciting projects or latest deals recently. Go ahead, Jennifer. We can start with you.
Hey guys. Can you hear me? There we go. My name is Jennifer. I'm a partner at Integra Partners, which is an early stage fund in Southeast Asia. We invest in companies that drive financial and healthcare inclusion in the early stage, both across Southeast Asia and to a certain extent South Asia as well. Very happy to be here.
Yeah, hi. Check. Yeah, Khailee, managing partner of 500 Global. So we're a venture capital firm headquartered out in Palo Alto. We invest globally. We manage now about $3 billion and we invest in about 81 countries. Now in Southeast Asia, we have seed funds, also growth stage funds as well, and love to contribute to the discussion of what qualifies as a winter or not, right?
Yeah, exactly.
From a quantitative perspective and other things. So thanks for having me.
Thanks.
Hi everyone. I'm Avina. I'm a partner at East Ventures. We are a seed to growth platform investing in Southeast Asia, primarily Indonesia. AUM is over $1 billion and excited to be here to discuss the stage of the early stage ventures.
Thanks, Avina. I'm Anup. I'm a managing partner at Orios Venture Partners. We've been in early stage investing since 2014. And this is our third fund. We invest $1.5 to $2.5 million in seed plus rounds. We are focused in India and participating in all sectors which are going to take India from a 3 trillion to a 5 trillion economy in the next few years.
Great. Thanks so much, everyone. So at DealStreetAsia, I'm responsible for the research team, and we launched a database product last year, so it's been going pretty well. I guess you guys, everyone have access to our database for a month. Please do. So I'm going to start with what we have in terms of data as of now, right? So last year, in terms of early stage deals, Series A and B in total was 187. Right? And as of last week, so the number is not final yet for the first 9 months, but it's around 180, 140, right? So I think that's a guaranteed 20% drop in terms of deal volume, right? But some would say, 20%, that's okay considering what's happening right now. So what do you guys think? What have you been seeing maybe in terms of what you've been doing in the early stage deals? Jennifer, maybe we can go with you.
Sure. So I definitely think that we are taking longer to do. I definitely think that the quality of deal flow that we've been seeing has been going up this year, which I think probably accounts for the fact that 20% is probably a reasonable drop in the light of market conditions, but it's not a huge drop in light of market conditions. I do think part of the reason why deal volume is going down is because investors are now actually taking their time to do due diligence, which is a good thing, right? As people who claim to be the smart investors and the smart guys in the room. So for us in Fintech, I do think that because the fundamentals of the sector are strong, and we can go a little bit more into that later, for us, we have been actively deploying over time. I was taking a look at our deployment numbers this morning, and so we closed our second fund, which is a $100 million fund investing in early stage and seed, Series A, Series B, $1 to $5 million checks. And we did a first close in April of 2021, so kind of right at the beginning of Q2. And since Q2 of last year to this year, our deployment has been fairly consistent each quarter across both kind of follow-on capital and existing startups as well as new startups. So, Khailee?
Well, you're passing the mic to me. I think that's good. No, we're having a lot of fun earlier in the holding room.
Just to interfere a bit, right? You meant, interestingly, due diligence is supposed to be better now, right? You can travel now, unlike 2021, right? How's that influencing deal volume for you, Khailee?
I think one comment about funding winter as it's termed, right? I think the semantics and the media wins, right, around the word winter, of course, is a bit more exciting than autumn, right? If you think the deal volume went down by 20% versus such a bumper year like last year, are we actually in a winter, right? Because it's easy to say winter, but when do we really qualify what it is? And some have to remember as well, like Singapore, Southeast Asia, this is a tropical region, so like we don't have 4 seasons. So what I'm trying to say here is that, like, from a data standpoint, like, although there's been an uptick of deals like last year, a new fervor, a lot of that's also correlated to new funds coming on board, and then they are quicker to deploy the moment they close and raise their funds.
Yeah.
So sometimes a lot of what you see as deal volume is more of a function of like venture capitalists raising money than it is about startups, like total amount of startups and the quality of startups coming around, right? So I just wanted to offer different dimensions behind, like, when someone says winter, what it might mean. Now, for us, we actually did a little bit of the opposite last year. Last year, we actually slowed down our deal pace. We saw that valuations last year throughout the past, especially through the COVID period, were getting just out of hand for us. So we actually slowed down the deal pace. We actually started to look a bit more critically at whether a lot of the founders and the companies would actually be high quality or not. But instead, like, from this past 1-2 months onwards, next 9 months, our internal targets is to do about 70 more new seed stage investments.
70, right.
Because we do think that actually the quality is starting to increase and valuations are starting to come down. So that's probably the comment from my side.
Can I do a follow-up? So
Yeah.
70 deals, how much does the region, Southeast Asia, contribute?
This 70 is just Southeast Asia.
Oh, just Southeast Asia.
Southeast Asia,
I
yeah.
see.
Because on the global side, we will be announcing some new funds for different parts outside of Southeast Asia this week.
Okay.
However, it's like Southeast Asia alone, 70 new seed investments
Okay.
for the next 9 months.
So despite the rebranding to 500 Global, you will still have region dedicated or even specific market fund?
So the nomenclature behind the rebranding, and this may be to the crowd, previously, like when the firm was born in 2010, it was called 500 Startups. But right now with the global presence, we've rebranded 500 Global, but also like the regional funds is like 500 Southeast Asia, 500 MENA, right?
Yeah.
500 Latin America. So it's more like geo names instead.
Yeah. Okay, cool. Avina, so last year I believe you did 80 deals, which is amazing, right? I'm curious how you guys did it. That's like one deal in every 4 days, right? And how much has that changed this year? Go ahead.
It is very exciting years actually for us, right? As you said, 80 deals, we're very proud and we remain very optimistic on the market. On the early stage, we do see it very, very active, so I think going head to head with Khailee here, trying to do deals this year. As Khailee said, right, there is no winter here in Southeast Asia. It's a tropical country. It's a rainy and dry season, essentially. And what we look is essentially the best of the founders and potential market in the region. So from that perspective, our investment thesis is really going, sector agnostic, looking at the best founders and really picking the best founders to invest in, regardless whether it's sunny or dry, rainy, winter or not, And for us, we raised a 550 million fund, just final close this May, and we do have a lot of dry powder. We want to back, best of the best entrepreneurs in the region.
Great, thank you. Anup, thanks for joining the all Southeast Asia team. So tell us, I believe, in India, in terms of deal numbers have gone down as well, but not dramatically, obviously. Can you share with us your experience so far this year?
Yeah, just looking at the latest data, so my team sent me the data for H1. Actually, the numbers have actually increased over last year in the early stage. That's basically up to Series A.
Up to Series A. Okay.
Up to Series A. So we're not actually seeing a winter. We expected a winter. I think there was a lot of media noise. But what's happening is that the valuations have come off, right?
Okay.
There was a lot of money chasing a lot of founders. I think what's happening is that same money is chasing fewer founders, right? And like you said, Avina, the same thing is happening. So the smarter founders are going to raise money regardless, right? But even they're not getting the valuations, right? So that's what really is happening. The bulk of the remaining founders are getting through, but they're getting through with some more effort. So overall, the deal volume is about as much. The deal making is much better than last year. So actually, it's a small blip. It's about 28% or something, according to traction data. And that's what we are seeing up to Series A.
Right. In terms of the process, the time to complete a deal, has it been faster this year?
No, I wouldn't say that. I think all fund managers are taking their sweet time. And everybody is consulting far more. Everybody's doing far more due diligence. Founders are more patient. There's no FOMO going around. People aren't moving from one office to the other and sending a text message, hey, I got a term sheet, are you interested? I'm just 15 minutes away in case you change your mind, and that's not happening. So
Okay. Just to follow up on valuation, by way of data, we track valuation per quarter. So what we found, at least for early stage, I'm talking about Series A and B, has been relatively, robust. Maybe a drop in, for the first time, I think in second quarter, Series B has come down significantly. But obviously, there's a lot of nuance to this, right? I mean, depending on the sector, obviously, Fintech is doing well. I mean, depending on the subcategory as well, right? So can you, tell us some of the nuances that are affecting valuation this year? Jennifer, maybe we can start with you.
Yeah, I mean, I think for us, I'll talk about us first and then I'll kind of talk about the market in general.
Right.
And I think for us, valuations have not changed significantly, but I think that's because we didn't ride the hype cycle up and we're not riding the hype cycle down.
Right.
And I think we have a very strong thesis in the fund that if we are early stage investors, as all these panelists with me are, that you have to be comfortable owning a company through a whole economic cycle, right? Because if you're a Series C or a Series A investor, then you have to be prepared to own a company for a long time. Now, sometimes you get lucky, sometimes you get really nice exits really quickly, but most of the time you have to be prepared that you're going to own a company when markets turn, and that may be when they're Series C or whether they're Series B, and you kind of have to take that into account. And so for us, I don't think we have really drastically changed the way that we approach due diligence or kind of how we think about valuations. But I do think that, what is influencing the way that we think and maybe the way that market thinks about valuations is that, of course, you see the big exits in the market and maybe that influences the way that some investors may think about exits in general, right? And so, what is possible when, the SPAC market is hot or when large tech companies are going on an acquisition spree may no longer be the case. And so if, you think your returns are going to be affected by your ultimate exit in the future, then you may also kind of pull back on valuations and what you're paying today. But I don't think that's necessarily the right approach. Like for us, I don't think we want to do that.
Right. Khailee, I mean, obviously you have a view of, you could compare Southeast Asia and what's going on globally.
Yeah.
Can you
Well, I think that what's a common theme, not just in Southeast Asia, but other markets as well, is that maybe like say 5-6 years ago, a lot of what's a seed, Series A, B, it's more focused on that round itself. There's no Series A1, A2, A3, or there's less of like a pre-B, so there's less of these like new cool trends, right? So I think it does affect how any research is done on what is a Series A. I'm sure you have tracked it, right?
Should we include this?
Exactly. So you have to actually recategorize,
do the
right?
median,
So I think that, but overall, I think it's actually a sign. I think it's a positive sign because it means that markets are getting more efficient. They're getting more liquid. You're actually seeing like more activity in between things. So it could come a time where even for secondaries, right, which I think you've got some familiarity with in the past, like you start to see private markets being more and more efficient, similar to public markets. So hence, when it comes to like, what's a median valuation and all that, I think a lot of our methods of researching it, also we keep up with the times and try to recategorize, right? So that's, I think, the nuance that we also try to pay attention to as we grade our own portfolio companies as they go.
Great, thanks. Avina, how's the Indonesia?
Yeah, I guess not just Indonesia. I guess it's a bit inevitable, right? When the public market tumbles, essentially, the growth and the late stage companies' valuation will sort of correlate with that because the way we underwrite investments, we also look at comparable multiples, and a lot of that are driven by the public market multiples as well. So from that perspective, growth stages companies, Series B and above, we probably see a little bit of slowdown in terms of fundraising. I think for the companies who raised last year, right, when the market was, at the peak, it was very, very good time, basically, to amass a lot of cash balance. I think we have one portfolio company, Sendit, that did exactly that. And at the moment, they have a lot of cash, for potential acquisition opportunities in the current market. So from that perspective, we do see a bit of slowdown in the growth stage. Let's see, next year where it is. I think it's still a bit of a flat internal round.
Right.
I have not seen much of a down round yet, at least, but I think the judge is yet to be out in the next 12 18 months.
If I can build on Avina's point, right? I think this is maybe more like a armchair theory, right, around like slowdown of Series B. But I think that because there's an expectation that maybe SoftBank Vision Fund isn't going to be hanging around in Singapore, right? And there's an expectation that Tiger has helicoptered out of the area. But I mean, they're still active, granted they've done some deals, right? But maybe there's this illusion or this optics, right, that those two won't be around to suck up the Series C and D. Hence, like some folks who classically do Series A and D, they're like, okay, well, if Tiger and SoftBank ain't around, what's the markup that I might have, right? So, I mean, this is just armchair theory, but.
Right. Just to follow up, you mentioned, comparable multiples. Is there some kind of a flock mentality that's pretty evident in the public market, right? But in the private market, my sense is, because in developed markets are, obviously in trouble, and some emerging markets as well. But India obviously is growing 7-8%, right? I mean, China now is below 3%, I think. And Southeast Asia at the same time, on average, as a region, is growing above EM average and above China. So do you think there's a mismatch in terms of, investor perception on, Southeast Asian assets or Indian assets in terms of value? Go ahead.
Okay. Go ahead. So, look, India's story is very different.
Right.
What's GDP? GDP is non-traded goods and services, right? India, despite being a 3 trillion economy, it actually behaves in purchasing power parity like a 10 trillion economy, because the amount of non-traded goods and services, the value of that is 10 trillion. So when you land into India, you get the feeling of a 10 trillion economy. So that's, and if you see the ratios for China as well, because for China also the ratio of non-traded goods and services, that means the things that they're bringing into China is less, and therefore that ratios are much more favorable. So when that happens, you can ride out some of these global, fears of inflation and recession, because you're not simply buying from the outside. And your population is really consuming goods and services produced inside at those costs. And that's what helps the economy to ride out that wave. Also, India has been, geopolitically quite smart. We've been buying gas and oil where it was cheap, and that's helped us as well, and we've had our independent stance. So I think when you do something like that with some of these structural changes that have happened in the last 5 or 6 years, which is the UPI, for those in Asia, you might want to Google that term. It's a peer-to-peer fast movement. You don't need to know account numbers. You can just do a payment to anyone free of cost. We've got GST, which has come in. We've got physical infrastructure being built. So I think some of these things help in the movement of these trades of goods and services within the country at lower costs than what it would take in some other economies, even when inflation is going up and the cost of inputs is going up. So, and some of the things like electrification and all of that are just riding it out. I mean, we're a sunny part of the world, so we should take in more renewables, guys. I mean that's also helping out, right? So climate's been a big theme as well.
Right. Yeah. Jennifer, do you think, in terms of repricing of assets at the moment, surely they consider, the fundamentals is still intact for Southeast Asia?
So, I do think, to your question, I would have a bit of a nuanced answer. I would say that, obviously kind of the fundamentals of what drives excitement around Southeast Asia startups is strong and will continue to be strong, right? Because, we're all sick of talking about the pandemic. But it's true that whereas in the past you were talking about, smartphone users in Manila or Jakarta or Ho Chi Minh City, now it's 440 million people, right? In the most rural parts of the region who are online and transacting digitally, using digital financial services, using telehealth. And that's also part of the reason why people are justifiably excited about Fintech, right? Because it touches every aspect of the digital or online economy. And what was the investor truism about China? Like maybe a couple of decades ago, right? If you have a company that can make $1 from everybody in China, then you have a company that has $1 billion in revenue, right? So, kind of like the demographic facts continue to be true, and they won't change no matter what else is happening in the world. But at the same time, I don't think that these kind of growth factors necessarily insulate Southeast Asia from the hype cycle. And, there were all manner of sins that occurred, possibly from some of the investors that Khailee may or may not have mentioned in his previous answer in Southeast Asia. And I think that's because investors were focused on market fundamentals and not business fundamentals. And you kind of need to do both. And I think investors this year are looking at both, which is the right approach. And so that's why I think this year is for us a much better year in terms of investing and probably getting better.
Yeah, I think to share a couple of data points as well, because I think, Avina, you rightly pointed out that there's been such a compression in public market comparables. But at the same time, if you're looking at Southeast Asia, to your question, is there like a pricing mismatch?
Yeah.
Right? Market fundamentals, yes, we can agree. Business fundamentals, when we find like a company that actually has multiple comparables in the US, that I'll give an example. We found a company, we were looking at the public market compressions. We looked at two companies in the US, Toast and Olo. They do restaurant POS, right? Point of sale in restaurants. Then we looked at our own portfolio and said, hey, even though Toast has compressed from 25 billion down to 9 billion, they have 60,000 paying customers, recurring paying customers. We have a company in our portfolio, StoreHub, that has 16,000 paying customers. But their valuation is not 9 billion or 3 billion or 2 billion. In fact, it's sub 100 million. So immediately we led the round for their pre-Series B, so to speak, $13.5 million. We had participation from Vertex and a few others. And because again, you find the pricing mismatch.
Yeah.
So I would say that there continues to be on a company by company level pricing mismatch, even though the US comparables have compressed a lot.
Right. Thanks so much for that.
I think I'll add to Khailee, right? Exactly to Kylie's point, we also see similar, so when a company fundamental are growing strong, right, regardless of where the market is, as long as they're still growing, we very happy to lead the rounds as well. Whether it's in internal rounds with many other follow-on investors as well, that's still something that's happening basically in this market.
Right.
We also see as investors, right now is actually a very good time to invest. I think last year the valuation expectation from the founders are skyrocket essentially. And now, given the market, I think a lot of the founders are much more realistic in terms of their price expectation as well.
Right.
I think looking at Southeast Asia, so going along with Anup's point, right, on India, Indonesia obviously right now is very, very popular because of the G20 presidency. We see a lot of investors are coming to Indonesia. I think last week there was super returns here in Singapore. So we do see a shift from investors allocating from China to Southeast Asia, and it's very heartwarming to see Southeast Asia and Indonesia on the map.
Right. So part and parcel to Southeast Asia's resilience, I think, partly is subsidies. Indonesia lifted subsidies recently, right? Prices will, usually in Indonesia when, fuel price going up, things get crazy, right? A lot of protests and whatnot. How concerned are you? Since we're discussing whether there's a funding winter, are we, sort of like in the autumn period towards, things gonna get harder, maybe specifically in Indonesia because of inflation?
I think globally that's basically the situation, right? Globally, I think people are talking about recession, inflation, geopolitical uncertainty as well. So obviously those are the environment where all the countries are operating. So hopefully, with Indonesia, Southeast Asia, where we are right now, we believe that the government is providing policies that are, beneficial for the country and the people, right? Obviously, fuel hike is never popular with the masses, right? But I think where it is right now, it's getting a little bit more stable. And for us, in terms of backing startups, right, there are a lot of innovations, technology that are actually creating products and services that are more affordable, essentially, or more accessible to the masses. And from that perspective, we hope that will benefit, essentially, in the current market environment.
Right. Anup, I think Indian startups is ahead of the curve in terms of when the inflation actually kicked in, right? What are some of the best practices? What do you tell your investees basically to deal with a challenging environment at the moment?
Yeah. So look, we always believe that the first person running is likely to be the last person standing. So we've always told our investees that when you've got an early product market fit, when you've got the cost right, the team is stable, then it's time to sprint, because there's a value in that which is seen by the market, and funding will happen, right? And you've got to, however, not run multiple experiments at the stage prior to that, because that's not the time for this. Okay. If you're going to waste your limited energies and therefore limited resources, because time is money, you're burning cash every moment, then you better be sure. So I think that sort of pragmatism has kind of come in. And that's come in without us having to tell them. So they're seeing that. The other thing that's happening is that founders are more open to taking in more cash, even at the last round, and the investors, including us, we are okay. If you're sitting on more cash, you're likely to be the last person standing, right? And because you need cash while you're going to sprint hard, even though you have the confidence that you're going to be the forerunner in that category or segment. So I think we're telling our companies to be prudent at the experimentation stage. But once they've got the confidence, sprint, take in the cash opportunistically, but keep the leadership, right? Because one thing you can't do as a founder is erode your own confidence and start to feel nervous at the same time that you're excited about having found that product market fit. And we as investors would be failing in our duty if we didn't work hard enough with our co-investors or the rest of the ecosystem to play out that story and get the deserving guys the support that they want, right? Okay. So I think that's where we are.
So I mean, early stage investment, I think it's all about growth, right? I mean, these are fairly new companies, and they want to expand, recruit people, but at the same time, there's a push towards sustainability, maybe show the timeline towards profitability, right? What are some of the measures that you guys have taken? I know some investors have introduced special terms, such as you got to meet a certain target. If you fail, we will get more stake in the company, stuff like that. So maybe Jennifer, can you tell us what are you doing at the moment?
So the answer is that we do it, but very, very selectively. And I think the reason for that is, so we'll do it when we see that there is a better way to align founder interests and investor interests, or if, we really believe in the company, but there's, a little bit, maybe not insurmountable, of a gap between valuation expectations between the founder and us, right? But fundamentally, I think we believe that a good deal structure cannot correct for a fundamentally bad investment, and especially in the early stage where outcomes tend to be a bit more binary, 20% or zero and 30% or zero is still zero. So, the short answer is yes, but very, very rarely.
I think for earlier stages, it's going to provide maximum flexibility, because the role of that is to discover the right business model to scale, right? You may have a sense of your product market fit, but you want to fit it in a way, that there's like a lot of nuance to that. So you want to have a lot of flexibility.
Right.
Then outcomes are pretty binary, right? So for seed stage, I don't believe in kind of like, putting too much artificial structure around the deal. But for the later stages, I also don't feel like it creates very good outcomes, to be like too fixated on hitting certain targets, then you unlock certain trenches. So we've tried to design recently, I don't know if it's a good instrument, but we've tried to design something where we're actually pricing in the follow-on check. So we're saying that, look, okay, we're going to cut this check, and then you grow, and then it's at our option in X amount of months whether we want to follow on at a price that we already agree, right? So then if they don't do as well as we kind of like by whatever measure we feel at the time, then we choose not to exercise it, and then we let it expire. But if, let's say, they totally exceed expectations and they really start growing in a way that's beautiful, then we will choose to exercise it. And so we're trying to innovate in ways which allows the founders to grow in a natural and organic way, but yet protect ourselves as investors and our investors as well.
Right, thank you. Avina, obviously you've been preparing follow-up funds, right, for your investees. Are you introducing any special terms?
Actually, interestingly to what Khailee mentioned, exactly what we do is very similar to what you do. Good.
At least you don't feel so exotic and alone. Yeah.
Yes, but all in all, we'd like to keep things simple, actually, especially in the early stage, and I think that thesis kind of goes to the later stages as well. So we like things simple, straightforward, less complication. So less spending time on that and more building the business.
Great. So we have less than 7 minutes for questions from the audience. So anyone want to ask the questions directly, or otherwise I can pick it up from the screen. Okay, so the first question from our audience: are exit options becoming more limited? Who wants to take it first? Go ahead. Anup?
Oh, okay. I mean, exit options discussing in an early stage panel is kind of difficult. But I'll try. So I guess the question is directed at exit at the late stages, right?
Yeah.
So I think it's all about price, right? There is a desired pricing, and then there is an actual pricing. And the gap has widened. Investors would love every investment to be whatever, 30x, 40x, etc., from the time that they invested at the early stage 5 years ago. But are they able to get it? No, not at this moment. You've got to be patient. Of course, if you've got a winner in the pack, you're likely to get that. If the company is inching towards profitability, the EBITDA level, at least in the Indian markets, that's very highly respected. We've seen that. The public market shavings of IPOs like Zomato and Paytm, etc., have given that tough lesson to every other company at the late stage, including those of our folio companies. And in fact, they're all of them are striving towards achieving that goal to get the best valuation. And that's our single sort of advice to all the founders at the late stage: sacrifice growth, have the right cost structures, move towards profitability.
Right. Khailee, I guess there's a huge exit for you guys, through Bukalapak.
Yeah, I think it doesn't matter what stage the fund, whether it's an early stage fund or a growth stage fund, I think definitely paying attention to exit climate and exit timing is important. So for us, like last year, we had 3 big exits. We had Grab, we had Bukalapak, and just being with them from the earlier stages all the way to IPO, it's of course disheartening to see the price go all the way up and then down somewhat, right? But fundamentally, the companies are very, very strong, and they've now amassed a lot more cash, and then they are run in a way that has a lot of resilient growth. So any fund manager who's not forced to actually sell, by the LP is not forced to sell, and they still have a few years left on the fund, we have to pay attention to when we sell, even though it's actually public already, right? And then if we sell at the wrong time, I remember our first fund had Twilio, this is a US fund, had Twilio. Twilio accounts for 6x of the whole NAV, that you can snap your fingers, become DPI. But had we sold a little bit earlier, it's actually only 2x DPI, right? So yes, I think that as far as exit climate is concerned, we pay a lot of attention to public markets.
For sure. Avina,
I think to add to Anup and Khailee's point, right? I think as market grows and become more mature, I think exit options should become more available. I think in terms of timing, obviously it's not the best time to exit at the moment, right? But as an overall, long-term cycle perspective, that's definitely what we see. So seeing the big tech in Southeast Asia already going public, that really leads the way for other tech companies to also create an exit, in the near term. And also, I think today, I think IPO is, probably the one that a lot of the founders think on their mind in terms of exit, but in reality, about 80-90% of exits actually come from M&A. And with a lot of companies amassing, cash, the big companies having cash, right, they actually create a lot of opportunities for M&A in the current market as well in terms of exit.
Great. So Fintech, I suppose, is the timeline shorter for Fintech in terms of exit? There's a lot of activity there. Obviously.
There's a lot of activity. We always model to an M&A exit, as Avina correctly pointed out. I think modeling to IPO is a pipe dream, and you can get very lucky. I think we think about exits in 2 ways. Either you are invested in a company where the technology is absolutely critical, and you've kind of mapped out the M&A market for who is likely to buy this business because it is going to be a critical part of their roadmap. And go to market going forward. And we had a really big exit last year in our first fund in cybersecurity that sold to IBM, where that was the case, and they paid, what was to us a fairly irrational multiple from a revenue perspective, but in terms of the market potential of the business together with IBM, and in terms of the value of the technology, probably very rational. In the case of most of our other portfolio companies, if you're going to sell into a bank or a digital bank or a financial services company, then you have to remember that these companies trade at very different multiples than what you invested in, right, in that startup. And so, it's a matter of, I think, again, how critical that asset is into the future of that business.
Yeah, for sure. So one last question from the audience. I think this is pretty topical. How do you see corporate governance and founder management given the recent blow up of Zilingo? So what lessons have you learned?
Okay,
are you guys implementing anything? Anyone? Any takers?
Everyone is silent.
No, we did invest, right? So we're not in a position to comment, right? So.
Okay, cool. Anyone else?
We didn't invest as well.
Yeah, I don't think anyone on this panel invested. But
everybody's avoiding
fine,
this.
I'll take it.
But Anup's very quiet. I don't know. He didn't say he didn't invest.
Don't know
okay,
enough.
I'll say
Nobody
one
wants to
thing, which is
weigh
at
in.
the early stage.
Okay.
People talk about the fact that now that we are in a buyer's market, we can negotiate better deal terms, better resolve matters, et cetera, into our shareholder agreements and whatnot. And I think that is the wrong approach to corporate governance, right? At the end of the day, it's about the founder relationship. And so if you want to do right, do your due diligence, make sure that you invest in founders that you've already done due diligence on. We've gotten some things wrong in the past, we've gotten some things right in the past, but at the end of the day, it's about the founder relationship, because you cannot enforce corporate governance if you are an early stage fund and it takes 2 years for a case to go to court, for example. So It depends on the relationship and how you manage that with the founder.
Okay, we have less than
Thank you.
30 seconds. Quick response, yes or no. Are we in a funding winter for early stage? Is it still hot? Yes or no?
We're investing.
Khailee?
Yeah, it's so hot. It's incredibly hot. But but the last word, there's this though. I think a lot of us, we pay attention to market trends and averages. But when you really look at VC is a game of outliers. In a winter season, if you pick like 1975, energy crisis, if you pick to invest in Microsoft or Apple at the time, that's a bumper season for you. In .com bust, if you pick LinkedIn, right, in a post.com bust, you pick LinkedIn or MailChimp, or on 2008 global financial crisis, if you back Airbnb, Uber, or Square, I don't care what season it is a bumper year for you. So I feel for LPs and VCs, we cannot be swayed too much by what's going on, because we are in the game of finding outliers.
Right.
So yes, tropical season.
Well said, Khailee. Avina, go ahead.
Very well said, exactly. We are actively investing at the moment, yeah.
Thanks. Anup,
No
last
winter in
words?
India. No winter in India. We're up versus last year.
Okay, thanks so much, esteemed panelists, for your time.
Thank you.
Thank you so much. Thanks to the audience.